Hi, this is Prarik Sam. Welcome to this live webinar. We've got a great, really interesting and very topical subject to discuss with you today. How to avoid inheritance tax when on property, business assets, investments and crypto when you die. We've been looking in this recent series about a number of different things and a number of different issues that affect expats living and working abroad. And what we wanted to do was try and bring it all together. Now, we've been talking about a capital gains tax and how that impacts on expats living and working abroad. If a UK expat leaves the UK, then they can avoid capital gains tax on business sales or on investment sales or on crypto sales. Now, there's a really fantastic piece of case law for a tax expert, for expats, that came out last week, and it was the HMRC's judgment finally run in the tax tribunal assessments. And this was a case that's been going on since 2000. Connected to the Matalan business in the UK, and the owner of Matalan went expat to live and work abroad, and then listed his company on the stock market. So it went from personal ownership to ownership of the company. Now that disposal is a capital gains tax event. So a UK expat can leave the UK. And then choose to sell the asset, which could be a business, it could be an investment, or it could be cryptocurrency. Cannot be UK property anymore. That will still be subject to capital gains tax. But a UK expat can go expat and sell the business or list it on the stock market away from his personal to a corporate ownership, and enable or for investments or for crypto sales. So if your crypto holdings are based in the UK, then they are subject. Even when you're trading, it's a capital gain. So buying and selling crypto is a capital gain. It's not income. So you've got personal allowances each year, but it becomes a capital gains liability. Now, if you go expat, leave the UK, then that any capital gains liability up to the 20% can be deferred for up to 5 years, and then it falls away. So if you're selling your business for 10 million or 100 million or 1 billion, a UK expat can go overseas and defer and avoid that capital gains liability. So the tax ruling that came out last week directly messed that up, and the reason was all about timing. So when you go expat, you have to go expat before you sell your business, before you sell your investments, before you sell your crypto. And once you establish that overseas tax residence, you can then do the disposal. In this case, and this case dates from 2000, and only in 2022 has the ruling come through. So that's how long this business person has had to live with the Matalan business, had to live with this potential liability hanging over them. And so it's okay if the tax liability is only 20% of your wealth, but to have a tax liability, the ruling was for 135 million pounds for an expat who's lived and worked abroad for 20 years for the capital gains liability on a business disposal that happened all those years ago. The reason being is that you have to go expat and be expat before you make that sale, and it wasn't done correctly. And because it didn't take the right advice and the right, excuse me a moment, because he didn't take the right advice and time things in the right way, he became liable, and he's fought it. His advisors, who were Pricewaterhouse, gave him the wrong advice. They made a mistake. They've got some liability as well, potentially. Taking the right advice, the right steps at the right time can avoid that capital gains liability if you're going expat with business, with crypto, and with investments. Okay, UK property. If you own UK property, you're going to be liable for that in any respect when that's sold. So that the capital gains liability on UK residential property, other than your main home in the UK, is 18 or 28% on the capital gain, including commercial or residential. So if you've got a property portfolio that you're renting out, that is the liability that you have. So capital gains is there, and it's with you all the way up until you die. Capital gains tax goes away when you die. It goes away when you expat and you sell UK assets subsequently. Taking the right advice, contact us at proactpartnership.com. And it goes away when you die. And that's the only other time you can get rid of the capital gains liability. But when you die, you've got inheritance tax. And inheritance tax is 40%. And as we've said in our previous webinars, go back and watch again on our YouTube channel, Proact Living Working Abroad. When you go expat, you can change your tax residence, which can save you capital gains tax, but it doesn't change your domicile, it doesn't change where you're from. So you're still from the UK. So even if you're from the UK and you've disposed of your business and your property and your crypto and your investment assets all in the UK, you're still domiciled in the UK, and you've still potentially got a liability to inheritance tax on your worldwide capital. They may or may not find you, but discrete tax planning in the past could work. But in the days where tax registration numbers are known by property agents, by banks, by investment companies, by pension companies, by your accountants, by your tax advisors, they're all linked together, and there's exchange of information since 2015 between countries. So if you live in Dubai, you live in tax-free Dubai, they're still exchanging information with where you're from, which is the UK. So exchange of information is there. So let's manage it and deal with it, and understand that as a UK expat, or as an expat with UK assets, you have a liability to 40% inheritance tax when you die. So if you've protected yourself from the capital gains tax, how do you protect yourself from the inheritance tax liability? How do you protect your family so it's your family that inherits your wealth and not the taxman back in the UK at 40%? So that's a big question to ask. And if you're lucky enough to end up with being one of Britain's richest people with a portfolio of 600 million, what you don't want when you die is a tax bill of 40% of 600 million, which is 240 million, or a capital gains liability of 135 million. So whether you're worth 1 million, 2 million, 10 million, 100 million, how do you avoid that inheritance tax so your family inherits your wealth and not the taxman? First step is to make a will. If you don't make a will, then the gifts and the allowances are more difficult to make, and you'll be caught up in the cost and delay of expense of that. In the EU, you're legally obliged to settle your worldwide estate in the country in which you're a tax resident. So if you're living in Spain or Portugal or Cyprus or another EU country and you die, then under EU law, common throughout all the EU countries, you're obliged to make a worldwide administration of your affairs in that jurisdiction. So anything that you own, business, property, crypto, investments, around the world is assessed in that country. So you've got a potential inheritance tax liability in the country in which you're in, which could be 40% as in the UK, it could be more, it could be less. So you've got in Cyprus, if you've got a Cyprus will and estate, there's zero inheritance tax on gifts, on any assets that are disposed of on death. So capital gains tax, if there's a sale of a Cyprus asset to a third party, but gifts to family members and there's no inheritance tax. So if you had a Cyprus-based business or property portfolio, and there's no family to inherit that, there wouldn't be any inheritance tax, but there'll be a capital gains tax on the disposal to the third party. But in other countries, the inheritance tax applies. Now, there are personal allowances, and that is a limit per person in the UK of 325,000, and that's not going to change before in the next 5 years. So, you have to be realistic. So that gives time for people to plan and to make gifts, and you can gift, and gifts can become potentially exempt. And maybe that takes 7 years, but I've got news for you. We are all going to die. You are going to die. Your children are going to die. Your business is going to die. Everything is going to die eventually. So, accept that and plan ahead. So, God willing, you're going to live more than 7 years. If you make your gifts now to family, they're potentially exempt from inheritance tax, and you get another 325,000 to give away in another 7 years' time. So potentially over a 28-year period, you can make 4 gifts of 325,000 exempt from inheritance tax. You can pay a lifetime inheritance tax. So if you wanted to give away 100 million, you can make a lifetime inheritance tax gift. How much is a lifetime inheritance tax gift? 20%. It's the capital gains tax rate. So if you gave your business away during your lifetime to your family, you pay 20%, which is the capital gains tax rate, as opposed to 40% inheritance tax rate. So that's another way to do that. If you give something away, you lose absolute control of that. So that becomes an issue as well. Between spouse, there's ways to give assets between spouse without it becoming without there becoming a capital gain or an inheritance tax liability. So if a couple don't have 325,000 of assets between them after second death or on first death, then those assets can be passed on second death. But if the husband and wife have got separate holdings of 325,000, they could both give away 650,000 every 7 years to mitigate and reduce that liability. So that is a very clear, open way. But hang on a minute. What if I've made a crypto fortune and I've got 2 million invested in crypto, or 5 million invested in crypto, or I've got a business that's just listed and it's worth 10 million or 20 million? How does that benefit me? How can I mitigate the tax on that? Well, what you can do there is create, you might not want to lose the control. You might want to control the asset and have access to the liability of the funds during your lifetime. Now, you don't need the assets in your name, though. What you need is to enjoy the benefits of that, whether that's sailing around the Mediterranean on your yacht, or enjoying the investment income from your crypto investment or business, or living in the property that you're living in. So there's lots of different ways that you can enjoy the assets without actually being in your name. So if we can gift those assets and build a portfolio in your own family investment trust instead of going through a third party, then that investment trust can enjoy. It doesn't die. Once you own a family foundation or a family trust, whether you've got companies in there, property in there, whether whoever owns those businesses in there, within the trust, there's no probate, there's no administration on death, and therefore it's free of inheritance tax long term. So, for example, in Cyprus, there's no gift between husband and wife, between family. So you could gift 1 million of assets of business and property and crypto and investment assets to family. You can gift 1 million. There's no inheritance tax, no capital gains tax on that transfer. And then it's in a Cyprus trust. The Cyprus trust has got zero tax on worldwide dividend, capital gains, or income. So I'm not saying that a property portfolio is still not going to have a rental income liability in the UK. What we're saying is that the property portfolio capital gains and inheritance tax liability is going to be nil. It's going to be nil in Cyprus. I've probably used the worst example possible because we've already said that on disposal of UK property, there's still a capital gains liability, whether you sell it or transfer it to your family or to yourself or to your own investment company. So the property is the asset that you would use as your gifting strategy to use your personal allowances to transfer that property without an inheritance tax or capital gains liability. But it certainly works for business shares, and it works for investments in crypto, that you can gift that into the trust and it can be free, and even if disposed by the trust, there's no capital gains or inheritance tax liability wherever that disposal is, whether it's a Middle East, Portugal, UK, Australian, or American asset. It can be disposed of with no Cyprus liability on that family trust. The trust endures and can own the assets in perpetuity. So as long as there's no underlying transaction in another tax jurisdiction, there's no liability. So you choose the liability that you want, but you can also plan to avoid the 40% inheritance tax liability that would otherwise become due when you die by owning your assets in a foundation. This is how some of the big American business people own their wealth, own their companies through their foundation, which is an American version of a trust. They have a charitable element to it, which again you can do with your own family trust, and the charitable element can itself be a tax-free gift and confers slightly more benefits on the arrangement and the family trust that you're organising. So there's lots of different ways you can utilise that, depending upon what the family does. But the family manages its own money, and the money then passes from generation to generation without ownership changing, and therefore you're avoiding inheritance tax or capital gains assessment unless there's an individual event. I mean, obviously, if you have got a crypto fund and you dispose of crypto, then that is a capital gains event on that in itself, in whatever jurisdiction it is. As far as avoiding inheritance tax when you die, which you will, then the family trust works across border and down generation for property, for business, for crypto, and investment assets. For more information, you can get guidance to that. You can either get it online using our retained client service, where for $300 a year or $30 a month, you can stay in touch and get access to online advice and guidance about how to manage your affairs, living and working abroad, or going expat. Or more detailed services available. If you contact us at productpartnership.com, we can offer you a free review online or in one of our offices to discuss your circumstance and plan to avoid capital gains liabilities and inheritance tax liabilities for your property, business, investments and crypto while you go expat and living and working abroad. But across the generations to avoid that inheritance tax, using the time that you've got between today and the day you die. So contact us, come on board, and thanks for joining us, and we'll see you again next time. So that was actually live on our YouTube Living and Working Abroad channel. We do a Wednesday webinar each Wednesday. We're putting